There is a final promise that sits at the heart of all intelligent investing. It's a quiet vow made between an investor and a business, a pact that separates the journey of the wealthy from the frantic scramble of the crowd. It is the promise of ownership without the burden of endless toil. It is the promise of a harvest without the need to constantly replant the entire field. Most people, when they think of a billion-dollar business, picture something immense, something tangible. They see sprawling factories, miles of railroad track, fleets of airplanes, colossal smokestacks churning against the sky. They see assets. They see things you can touch, things you can count, things that show up on a balance sheet as solid, reassuring numbers under the heading property, plant, and equipment. But this vision, this deeply ingrained mental image of what constitutes a great enterprise, is one of the most expensive misunderstandings in the history of finance. It is a costly market mistake that has trapped generations of investors in a cycle of diminishing returns, a hamster wheel of reinvestment where companies must run faster and faster just to stay in the same place. The true giants, the businesses that create lasting, generational wealth, are often built on nothing you can see at all. They are built on whispers, on habits, on trust. They are built on ideas, on networks, on a name that echoes in the minds of millions. These are the capital-light champions, the businesses that have unlocked the secret to generating cash without the constant, voracious need for reinvestment. They are the ultimate financial machines, and understanding their nature is the key to transforming your portfolio from a collection of stocks into a portfolio of cash-gushing partnerships. This is the path to true financial freedom, not by chasing fads or timing the market, but by learning to see the invisible architecture of the world's most dominant companies. We are about to embark on a journey deep into the mind of the master, Warren Buffett, to uncover the 5 foundational pillars of this strategy. This is not just a lesson in stock analysis. It is a fundamental rewiring of how you perceive value, a piece of financial education designed for the retail investor, the serious entrepreneur, and anyone with the CEO mindset who understands that the goal isn't just to make money, but to own the machines that make money effortlessly. The first pillar, the very bedrock of this entire philosophy, is what can only be described as the gospel of intangible value. It is a radical departure from the accounting-driven, asset-focused worldview that dominates traditional financial analysis. It is the recognition that the most valuable asset a company possesses is often the one that an accountant is forbidden from ever putting on the balance sheet. It is the power of a brand, the loyalty of a customer, the strength of a network. To truly grasp this concept, we must travel back in time, not to a bustling Wall Street trading floor, but to a quiet corner of California in 1972, to a small, family-owned chocolate company that would fundamentally and permanently alter Warren Buffett's investment DNA. The company was See's Candies. On the surface, it was an unremarkable business. It sold chocolates from a collection of stores, a simple and ancient enterprise. When Buffett's partner, Charlie Munger, first brought him the deal, Buffett's initial reaction was one of skepticism. The sellers, the See family, were asking for $30 million. The company's net tangible assets, the storefronts, the candy-making equipment, the delivery trucks, were only valued at about $8 million. To the Buffett of that era, a student of Benjamin Graham's school of cigar butt investing, this was heresy. Graham had taught him to buy businesses for less than the value of their tangible assets, to find discarded cigar butts on the ground with one free puff left in them. You were supposed to buy $1 for 50 cents. The See family was asking him to pay $1 for about 25 cents worth of physical stuff. He was being asked to pay a $22 million premium for what exactly? For goodwill? For a name? For something an accountant would dismiss as a phantom of the marketplace. This was the critical moment of decision, the crossroads between the old way and the new. Munger pushed. He saw what Buffett was just beginning to understand. The value of See's Candies was not in its kitchens or its display cases. The value was in the mind of every customer who walked through its doors. It was in the decades of positive association, the memory of a grandmother buying a box for Christmas, the implicit trust that a box of C's was a mark of quality and affection. This intangible asset, this brand, gave C's a truly magical economic power. Pricing power. Every year, after Christmas, the company could raise its prices by a small amount, say 10%, to cover rising costs of sugar and labor, and customers would barely notice. They weren't just buying chocolate, they were buying a feeling, a tradition, a guarantee of quality. They would not switch to a cheaper generic brand to save $1, because the experience wasn't the same. This small, seemingly insignificant detail was the key to the kingdom. A business that can raise its prices year after year without losing customers has a fortress around its economics. Buffett, after much persuasion from Munger, finally saw the light. They paid the $30 million. Over the next several decades, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was sent back to headquarters in Omaha to be deployed in other investments. And the most beautiful part? It required very little additional capital investment. They didn't need to constantly build massive new factories or invent revolutionary new technologies. The brand did the heavy lifting. The $22 million investment in an invisible asset became one of the greatest engines of portfolio growth in modern history. See's Candies taught Buffett the most important lesson of his career. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the source of that wonder, more often than not, is intangible. This anecdote reveals a profound psychological principle that holds most investors captive. It's a cognitive flaw we can call the tangibility bias. Our brains, evolved over millennia to navigate a physical world, are hardwired to give more weight and credibility to things we can see and touch. A massive steel mill with billowing smoke and thousands of employees feels more real, more valuable, and more permanent than a brand name that exists only as a collection of neurons firing in the collective consciousness of consumers. When an investor looks at a balance sheet, their eyes are naturally drawn to the large, comforting number next to property, plant, and equipment. It feels like a floor under the stock price, a margin of safety. This is an illusion. The psychologist Daniel Kahneman calls this phenomenon, "what you see is all there is," or WYSIATI. We make judgments and decisions based on the information that is immediately available, and we fail to consider the vast universe of information that is absent. The balance sheet shows you the cost of the factory, but it doesn't show you the brutal competitive landscape that renders that factory barely profitable. It shows you the value of the airline's fleet, but it can't show you the crippling price wars and union disputes that will consume every dollar of potential profit. Conversely, the balance sheet of a company like Coca-Cola or Moody's, the credit rating agency, shows very little in the way of tangible assets relative to their immense profitability. The true asset, the global brand recognition of Coke or the entrenched trust in a Moody's rating, is invisible to the accountant, and therefore invisible to the investor who relies solely on what they can see. Buffett's genius, honed by the See's Candies experience, was to overcome this bias. He trained his mind to see the invisible. He understood that a brand that commands loyalty in the mind of a consumer is a far more durable and valuable asset than a machine that will rust and become obsolete. This is a form of second-level thinking. The first-level thinker sees the factory and says, "This is valuable." The second-level thinker asks, "What is the return on capital that this factory can generate over the next 20 years in a competitive market?" The first-level thinker sees a low price-to-book ratio and gets excited. The second-level thinker, the intelligent investor, understands that book value is often a historical artifact, a meaningless number that says more about the past than the future. Overcoming the tangibility bias is the first and most crucial step toward building real long-term wealth in the stock market. So how can you, as a retail investor or an entrepreneur, translate this powerful psychological insight into a practical, repeatable process? You need an applied mental model, a blueprint for auditing the intangible strength of a business. Let's call it the Brand Power Audit, a three-step process inspired directly by Buffett's experience with See's Candies. Step 1 is the pricing power test. This is the most important question you can ask about any business. Can the company raise its prices by a modest amount each year, year after year, without a significant loss of customers or market share? Think about your own life. Does your cable company have pricing power? Probably not. If they raise prices, you'll actively look for alternatives. Does your local gas station have pricing power? No. You'll drive across the street to save 3 cents a gallon. Now think about Apple. When they release a new iPhone that is slightly more expensive than the last, do their customers abandon them in droves for cheaper Android phones? No. The lines get longer. That is pricing power. Think about See's Candies. They could increase the price per pound, and their loyal customer base, conditioned by decades of positive experience, would pay it without a second thought. To apply this, look at a company's historical financial data. Look at their revenue growth and their volume growth. If revenues are going up faster than the number of units they sell, that's a strong indicator of pricing power. Step 2 is the no-brainer test. Do customers choose this product or service out of pure habit, loyalty, or as a mental shortcut, without conducting a rigorous analysis of the alternatives? When you walk into a convenience store anywhere in the world, thirsty, you don't conduct a chemical analysis of the available brown bubbly sugar water. You grab a Coke. It's a no-brainer. This habit, multiplied by billions of people over decades, is worth hundreds of billions of dollars. When a company needs a credit rating for its bonds, its CFO doesn't create a complex spreadsheet to compare dozens of small rating agencies. They call Moody's or S&P. It's the default, the trusted choice. This no-brainer quality is a hallmark of a powerful, intangible asset. It reduces the customer's cognitive load and creates a sticky, recurring revenue stream for the business. Step 3 is the substitution test. How easily could a competitor, even one with a massive amount of capital, replicate the core value proposition of the business? Could you, with $1 billion, launch a new cola to seriously challenge Coca-Cola? People have tried for 100 years, and all have failed. The asset is not the secret formula. It's the century of memories and marketing built into the brand. Could you, with $5 billion, create a new credit card network to challenge Visa or MasterCard? The problem isn't the technology, it's the network effect. You need to convince millions of merchants to accept your card, but they won't until millions of customers have it, and customers won't get it until merchants accept it. It's a catch-22 that creates a nearly impenetrable business moat. By running a potential investment through this three-step audit, pricing power, the no-brainer test, and the substitution test, you begin to train your mind to see the invisible fortress that surrounds a truly great capital-light business. This is the first step in your stock market analysis, a qualitative filter that precedes any quantitative work. To fully appreciate the wisdom of this approach, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the siren song of the asset trap, a mistake that looks so logical and safe on the surface but leads to financial ruin. The average investor, conditioned by the tangibility bias, actively seeks out companies with massive tangible assets. They look at a balance sheet and see $1 billion in property, plant, and equipment, and they think, this is a safe investment. There's real stuff here. The company has a high book value. This is one of the most dangerous misconceptions in personal finance. In many cases, a large base of tangible assets is not a safety net, it's an anchor. Consider the airline industry, a classic example of the asset trap. An airline's balance sheet is filled with billions of dollars worth of airplanes. These are impressive, tangible assets. But what is the economic reality of owning these assets? The competition is absolutely brutal. Dozens of airlines fly the same routes, forcing them to compete almost entirely on price. There is no brand loyalty to speak of. Customers will switch carriers to save $20 on a flight. The assets, the airplanes themselves, require constant and ruinously expensive maintenance. And worst of all, technology is always advancing, forcing airlines to constantly spend billions more on new, more fuel-efficient planes just to keep up with their competitors. They are on a capital expenditure treadmill. As Buffett famously quipped, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money. The industry has collectively destroyed more capital than it has created. The same is true for many other capital-intensive industries, like steel manufacturing or auto production. They have enormous assets, but those assets don't give them any durable competitive advantage. Instead, they become a black hole for capital, requiring constant reinvestment just to maintain their current position. The 99% of investors fall into this trap because they confuse the presence of assets with the existence of a good business. They are playing a different game. They are focused on liquidation value, on what the stuff is worth. The intelligent investor following Buffett is focused on earning power. They understand that the goal is not to own a museum of impressive machinery, but to own a business that gushes cash for its owners. The asset trap is a crowded path, littered with the portfolios of those who valued the visible over the valuable. The divergence between these two paths has a direct and profound connection to the financial statements of a company, and ultimately, to your own journey toward building wealth. The principle of intangible value manifests itself in a simple but incredibly powerful ratio: return on tangible assets. Imagine two businesses, Business A and Business B. Both generate $5 million in pre-tax profit each year. On the surface, they might look similar. But now let's look at their balance sheets. Business A is a capital-light wonder, a company built on a powerful brand, perhaps a software company or a franchise operator. It has just $10 million in net tangible assets, some office buildings, servers, and equipment. Business B is a classic capital-intensive company, perhaps a small manufacturing firm. To generate its $5 million in profit, it requires a massive factory and expensive machinery, totaling $100 million in net tangible assets. Now let's calculate the return. Business A generates $5 million of profit on a $10 million asset base. Its pre-tax return on tangible assets is a staggering 50%. For every dollar of physical capital tied up in the business, it generates 50 cents in profit each year. Business B generates the same $5 million of profit, but it requires $100 million in assets to do it. Its return on tangible assets is a meager 5%. For every dollar of capital invested, it generates only a nickel in profit. Which business would you rather own? The answer is obvious. The genius of the capital-light model is that it doesn't require huge infusions of new capital to grow. If Business A wants to double its profits, it might just need to increase its marketing budget or expand its sales force. It can scale with minimal new investment. If Business B wants to double its profits, it likely needs to build another $100 million factory. This requires massive new capital, which either dilutes the existing owners through stock issuance or adds debt to the balance sheet. This is the mathematical core of the Buffett strategy. He is hunting for Business A. He is looking for companies that can grow and prosper without needing to constantly consume shareholder capital. This high return on tangible assets is the engine of compounding. It's what allows a business to generate enormous amounts of excess cash that can then be returned to shareholders through dividends and buybacks, supercharging portfolio growth and accelerating the path to financial independence. It all starts with rejecting the gospel of assets and embracing the gospel of intangible value. This leads us directly to the second great pillar of our philosophy, which is the inverse of the first: a deep and abiding understanding of the tyranny of capital intensity. If the first pillar is about what to look for, this one is about what to avoid at all costs. It's about recognizing the businesses that are not designed to enrich their owners, but are instead designed to consume capital in a relentless, soul-crushing cycle. There is no more powerful or personal illustration of this principle than Warren Buffett's own experience with the business that gave his legendary company its name, Berkshire Hathaway. Before it was the most respected holding company in the world, Berkshire Hathaway was a failing textile mill in New Bedford, Massachusetts. In 1962, Buffett, still in his Ben Graham phase, started buying its stock. It was cheap. The stock was trading for less than the company's working capital, a classic net-net investment. He saw a statistical bargain. What he failed to see was the economic reality of the business itself. The American textile industry was in a state of terminal decline. It was a commodity business, meaning there was no difference between a yard of textile lining from Berkshire and one from a competitor in the South or, increasingly, from overseas. There was no brand, no pricing power. It was a brutal dog-eat-dog world of price competition. The only way to compete was to have the most efficient, most modern equipment. This created a terrible dynamic. Every time the company managed to squeeze out a small profit, that money had to be immediately reinvested in new looms and machinery, not to get ahead, but simply to avoid falling further behind. Every dollar earned was a dollar that had to be spent. Buffett later described this as running on a treadmill. The company would spend millions on new equipment to improve efficiency, only to see its competitors do the same, and the resulting cost savings would be immediately competed away and passed on to the customers in the form of lower prices. The owners never got to keep the rewards of the investment. It was a black hole for capital. Buffett fought this battle for 20 years, from 1965 to 1985, trying to keep the textile operations alive. It was an agonizing lesson in the economics of a bad business. He later confessed that this investment was one of his biggest mistakes. While he eventually made money on the stock through savvy capital allocation, the underlying business itself was a terrible drain. This first-hand experience, this two-decade-long struggle against the relentless tide of capital intensity, forged in him an ironclad resolve to never again get involved in such a business. It taught him that the quality of the business economics was far more important than the statistical cheapness of the stock. He learned that the worst kind of business is one that grows rapidly and requires significant capital to do so, but earns a poor return on that capital. The textile mill was the perfect, painful teacher of this powerful lesson. The reason so many CEOs and investors remain trapped in these capital-intensive nightmares can be explained by a pair of powerful psychological principles: the sunk cost fallacy and commitment bias. The sunk cost fallacy is our tendency to continue with an endeavor if we have already invested time, effort, or money in it, whether or not the current costs and benefits suggest we should. Imagine you've spent $500 million building half of a new factory. New market data emerges showing that the factory will never be profitable. The rational decision is to abandon the project immediately and save the remaining $500 million. But that's not what most people do. The thought of wasting the initial $500 million is so psychologically painful that they will throw good money after bad, investing the second $500 million to complete the factory, thereby locking in even greater losses. This is what Buffett was fighting with the textile mill. Year after year, he had to decide whether to pour more money into new looms. The money already spent was a sunk cost, but the psychological weight of it was immense. Closely related to this is commitment bias, our need to remain consistent with our past decisions and beliefs. A CEO who has championed a massive capital project, who has staked their reputation on its success, will find it almost impossible to admit they were wrong. They will continue to fund the project, to talk up its prospects, to filter information in a way that confirms their initial decision, long after the evidence points to failure. This is not just an issue for CEOs. It affects investors too. An investor who buys shares in an airline or an auto manufacturer has, in a way, committed to the belief that this capital-intensive model can work. When the company announces a new $10 billion investment in a new factory or fleet, the investor, instead of seeing it as a potential drain on future returns, often sees it as a sign of progress and commitment, reinforcing their initial decision. These cognitive biases create a powerful psychological gravity that pulls capital toward low-return, asset-heavy businesses and keeps it there. It explains why industries with terrible long-term economics can continue to attract investment for decades. The intelligent investor must build a mental defense against these biases. They must learn to evaluate every new investment decision based only on future prospects, not past commitments, and to be ruthless in assessing whether a business is a consumer or a generator of cash. To build this defense, you need a practical mental model, a quantitative tool to cut through the corporate storytelling and psychological biases. This tool is the maintenance versus growth CapEx filter. It requires you to do a little bit of detective work in a company's financial statements, but the payoff is enormous. Capital expenditures, or CapEx, is the money a company spends on its long-term assets, like property, plant, and equipment. You can find this number on the cash flow statement. However, this single number mixes two very different types of spending. The first is maintenance CapEx, which is the money required to simply maintain the company's current level of operations, replacing worn-out machinery, repairing old buildings, keeping the lights on. The second is growth CapEx, which is money spent on new projects intended to expand the business, building a new factory, entering a new market. A capital-intensive business is one where maintenance CapEx consumes a huge portion of its cash flow. So here's the blueprint. Step 1. Open a company's most recent annual report, the 10K. Go to the cash flow statement and find the line item for capital expenditures. Step 2. This is the detective work. Read the management's discussion and analysis section of the report. The company won't give you a perfect breakdown, but they will often discuss their major capital projects. You are looking for clues to separate the cost of just staying in business from the cost of growing. Sometimes, you can estimate maintenance CapEx by looking at the annual depreciation charge on the income statement, as over the long run, the two should be roughly equal for a stable business. Step 3. Calculate the maintenance CapEx ratio. This is your estimated maintenance CapEx divided by the company's cash flow from operations. This ratio tells you what percentage of the cash the business generates is immediately consumed just to keep the treadmill running. A company with a high ratio, say over 50%, is a massive red flag. It means that more than half of every dollar the business brings in, the door is already spoken for before the owners get a chance to see any of it. In contrast, a capital-light business, like a software company or a brand powerhouse, will have a very low maintenance CapEx ratio. Their assets are code or brand equity, which don't wear out in the same way a machine does. This simple filter is an incredibly powerful tool for any retail investor. It allows you to quickly sort businesses into two piles: the capital gluttons and the cash generators. By focusing your stock analysis on the second pile, you dramatically increase your odds of achieving the portfolio growth necessary for true financial independence. Now we turn to the antithesis, the flawed logic of the 99%, which in this context can be called the growth at any cost fallacy. The average investor, and much of Wall Street, is obsessed with top-line growth. They hear a company announce a massive new expansion project, a billion-dollar investment in a new facility, and they get excited. They see headlines about revenue growth and assume that this must be good for shareholders. This is a classic first-level thinking mistake. They are confusing activity with progress. Growth is only good if it generates a high return on the capital invested to achieve it. Growth that requires massive capital investment for a low return is not just unhelpful, it is actively destructive to shareholder value. Let's take a regulated utility company as an example. A utility might announce a $5 billion project to build a new power plant. This will certainly grow the company's asset base and its revenues. The stock analysts might cheer. But what is the reality for the owners? The utility's returns are capped by regulators. They might only be allowed to earn, say, a 6% return on that new $5 billion investment. That's $300 million in new profit. But to get it, they had to spend $5 billion of shareholder capital. The company got bigger, but did the owners get richer? A 6% return is paltry, likely below the company's true cost of capital. The money could have been used to buy back stock or pay a special dividend, which almost certainly would have generated a better return for the owners. Yet because of the growth-at-any-cost mindset, this kind of value-destroying expansion happens all the time. The 99% chase the story of growth. They look at rising revenue charts, but they fail to ask the critical question: at what cost? An intelligent investor understands that growth is a component of the value equation, not the equation itself. A business that grows its profits by 5% a year with zero capital investment is infinitely superior to a business that grows its profits by 15%, but has to spend every dollar it earns to do so. The former is a wealth creator, the latter is a treadmill. Avoiding the siren song of growth for growth's sake is a crucial discipline for anyone serious about long-term investing and wealth management. The direct financial connection of this principle is found in the most important line item for any serious investor: free cash flow. The calculation is deceptively simple. Free cash flow equals cash from operations minus capital expenditures. This is the truth serum of finance. It tells you, after all the accounting games and corporate narratives are stripped away, how much actual cash is left over at the end of the year for the people who own the business. This is the cash that can be used to pay dividends, buy back stock, make acquisitions, or pay down debt, all actions that directly benefit shareholders. The tyranny of capital intensity is a direct assault on this number. In a capital-intensive business like an airline, a car manufacturer, or a heavy industrial company, the capital expenditures figure is a monster. It is huge, relentless, and unforgiving. It devours the cash generated by the operations, leaving little, if anything, left over for the owners. Let's make this tangible. Consider a mature software company like Microsoft. Its primary asset is code, which has already been written. The cost to sell one more copy of Microsoft Office is virtually zero. As a result, its capital expenditure needs are relatively low: some servers, some office buildings. A huge percentage of its massive operating cash flow converts directly into free cash flow. In a typical year, its free cash flow margin, free cash flow divided by revenue, can be in the range of 30 to 40%. Now compare that to a major automaker like Ford. To compete, Ford must constantly spend billions of dollars retooling factories for new models, developing new engine technologies, and maintaining its vast physical infrastructure. Its capital expenditures are enormous. As a result, its free cash flow margin is often in the low single digits, and in bad years it can be negative. For every dollar of revenue, Microsoft's business model generates 10 or 20 times more actual cash for its owners than Ford's does. This is not a criticism of Ford. It is a simple statement about the economic realities of their industry. As an investor, your job is to position yourself in the river of cash, not in the desert. Understanding the devastating impact of capital intensity on free cash flow is the key. This single insight can protect you from entire industries that are structurally designed to be poor long-term investments, guiding your asset allocation toward the capital-light champions that are the true engines of capital gains and lasting wealth. This relentless focus on cash brings us to the third and perhaps most vital pillar: the free cash flow fountain. This is the ultimate prize, the end goal of identifying capital-light businesses. Free cash flow is the oxygen of a business, the source of all value for an owner. To understand its power, we can look at another of Buffett's transformative early investments, the acquisition of the Buffalo Evening News in 1977. At that time, in many cities, the dominant local newspaper was one of the greatest businesses imaginable. It was a local monopoly on information. If a local business wanted to advertise, or if someone wanted to check the movie times, or sell a used car, they had to go through the newspaper. This created an incredible business moat, and economically it was a capital-light marvel. Once you owned the printing press, the incremental cost of printing one more newspaper was tiny. The business required very little reinvestment. It didn't need to constantly upgrade its one printing press. As a result, it gushed cash. Buffett bought the Buffalo Evening News for about $32 million. Over its life under Berkshire's ownership, it generated hundreds of millions of dollars in free cash flow, cash that was sent back to Omaha. This newspaper, much like See's Candies and Berkshire's insurance operations, became a, quote, fountain. It produced far more cash than it could sensibly reinvest in its own operations. This torrent of cash from the newspaper, the candy store, and the insurance float became the seed capital for Buffett's legendary career. He used this cash, generated by capital-light businesses, to buy shares in other capital-light giants like Coca-Cola and the Washington Post. This anecdote illustrates the ultimate strategic advantage of owning a capital-light business. The cash is untethered. It is liberated from the needs of the core business and can be allocated to whatever opportunity offers the highest prospective return, anywhere in the market. A capital-intensive business, by contrast, has its cash flow shackled to its asset base. Any money it makes must be fed back into the machine. Owning a free cash flow fountain is like owning a golden goose that lays eggs you can use to buy other golden geese. This is the secret to exponential portfolio growth and the very essence of a successful long-term investment strategy. The psychological principle that underpins an appreciation for free cash flow is the combination of delayed gratification and second-level thinking. Most of the financial world, from cable news commentators to amateur investors, is obsessed with a single, highly flawed metric: earnings per share, or EPS. It's the headline number in every quarterly report. This is first-level thinking. It's easy to understand and easy to track. However, reported earnings are a product of accounting conventions and can be easily manipulated. A company can boost its reported earnings by changing its depreciation schedule or using other accounting tricks, even while its underlying business is weakening and its cash generation is deteriorating. To focus on free cash flow requires second-level thinking. It means looking past the polished headline number to the messier but far more truthful cash flow statement. It requires asking the deeper question: I don't care what the accountants say you earned. How much cash did you actually put in the bank for me, the owner? This requires a degree of intellectual effort that most market participants are unwilling to expend. Furthermore, embracing a free cash flow-based approach requires the discipline of delayed gratification. A stock's price might jump in the short term because it beat EPS estimates. But long-term value creation is driven not by accounting earnings, but by the discounted value of all the future cash that a business will generate for its owners. The intelligent investor is willing to forgo the short-term thrill of an earnings beat in favor of owning a business that will produce a reliable and growing stream of cash for decades to come. They are playing a long game. They understand that while earnings are an opinion, cash is a fact. This mental shift from an earning-centric worldview to a cash flow-centric worldview is one of the most significant steps an investor can take on the path to financial maturity and independence. To put this into practice, we need an applied mental model, a specific blueprint for calculating what a business truly earns. Buffett himself provided this in his 1986 letter to shareholders, where he introduced the concept of, quote, owner earnings. This is his refinement of free cash flow, and it represents the true surplus a business generates. The formula is owner earnings equals net income plus depreciation and amortization, average annual maintenance capital expenditures. Let's break this down into a step-by-step guide for the retail investor. Step 1. Start with net income. You can find this at the bottom of the income statement. This is the company's reported profit, our starting point. Step 2. Add back depreciation and amortization. You can find these on the cash flow statement. These are non-cash charges. A company doesn't actually write a check for depreciation. Accountants use it to spread the cost of an asset over its useful life. Since no cash actually leaves the business, we add it back to get a clearer picture of cash generation. Step 3. This is the crucial and most difficult step, subtracting maintenance capital expenditures. As we discussed, companies don't break this out for you. You have to estimate it. For a stable, slow-growing company, using the average depreciation charge over the past few years is a reasonable proxy. For other companies, you have to read the annual reports and use your judgment to separate the stay-in-business CapEx from the growth CapEx. This is the art of investment analysis. The number you are left with, owner earnings, is the holy grail. It is your best estimate of the amount of cash the business generated that is truly available to be distributed to the owners. By taking the time to go through this calculation, you move beyond the superficial analysis of the crowd. You are adopting a CEO mindset, looking at the business as an owner, not as a speculator renting a stock. This rigorous, cash-focused approach to stock analysis is a cornerstone of building a resilient, high-growth portfolio. The antithesis to this rigorous approach is the pervasive and dangerous practice of earnings per share worship. The entire ecosystem of Wall Street analysts, media, and traders is built around the quarterly ritual of the EPS estimate. Did the company meet, beat, or miss the consensus EPS number? A company that beats the estimate by a single penny can see its stock soar, while one that misses by a penny can see it collapse. This creates perverse incentives for corporate management. They know that their bonuses and job security are often tied to this number, so they will do everything in their power to manage it. This can lead to disastrous long-term decisions. A company might slash its research and development budget or delay essential maintenance on its factories, actions that hurt the long-term health of the business, just to ensure that it hits the quarterly EPS target. This is the equivalent of a student cramming for a test to get a good grade, but not actually learning the material. They are optimizing for the metric, not for the underlying reality. An investor who worships at the altar of EPS is playing a dangerous game. They are allowing their investment decisions to be guided by a managed, often misleading number. They can be fooled into buying a company that shows rising EPS, but whose cash flow is actually shrinking because it is underinvesting in its business. The intelligent investor knows that the stock market, in the short run, is a voting machine, driven by emotions and simplistic metrics like EPS. But in the long run, it is a weighing machine, and what it weighs is cash. By focusing on owner earnings and free cash flow, you are aligning yourself with the long-term weighing machine, not the short-term voting machine. This is a fundamental strategic choice that separates the intelligent investor from the speculator. The direct financial connection here is all about valuation and total shareholder return. The value of any financial asset, whether it's a stock, a bond, or a piece of real estate, is the present value of the cash it will generate for its owners over its lifetime. A business that generates high and growing free cash flow is, by definition, more valuable than one that does not. But the connection is even more direct than that. A company with a gusher of free cash flow has a powerful arsenal of tools to directly enrich its shareholders. First, it can reinvest that cash into high-return growth projects if they are available. Second, it can pay a dividend, sending the cash directly to your brokerage account. Third, and perhaps most powerfully in a capital-light world, it can buy back its own stock. When a company repurchases its shares, it reduces the total number of shares outstanding. This means your individual slice of the ownership pie gets bigger. Let's use a simple example. A company earns $100 million and has 100 million shares outstanding. Its earnings per share is $1. You own 1 million shares, or 1% of the company. The company generates $20 million in free cash flow and uses it to buy back 20 million of its shares on the open market. Now, there are only 80 million shares outstanding. The next year, the business is flat and still earns $100 million. But now, the earnings per share is 100 million divided by 80 million shares, which is $1.25. Your earnings per share went up by 25%, even though the business didn't grow at all. Your ownership stake, still 1 million shares, is now 1.25% of the company. This is the silent, tax-efficient magic of buybacks, fueled by free cash flow. It is how great, capital-light businesses can produce spectacular capital gains for their long-term owners, providing the financial fuel for true wealth management and financial freedom. Having established the importance of intangible assets and the free cash flow they produce, we arrive at the fourth pillar, identifying the moat, the defensive architecture of intangible assets. A great business is not enough. It must be a durable business. It needs a defense, a moat, as Buffett calls it, to protect it from the relentless attacks of competitors. And the strongest, widest moats are almost always built not from tangible assets, but from the invisible forces of intangible advantage. The perfect story to illustrate this is the American Express salad oil scandal of 1963. A company called Allied Crude Vegetable Oil was a major client of American Express's warehousing division. Allied borrowed huge sums of money from banks, using its inventory of salad oil stored in Amex's tanks as collateral. The scandal broke when it was discovered that the tanks were mostly filled with seawater, with only a thin layer of oil floating on top. Allied collapsed, the loans defaulted, and Wall Street panicked. They assumed American Express, which had guaranteed the collateral, would be on the hook for massive losses that could bankrupt the company. Amex stock plummeted by over 50%. The market was terrified. But Warren Buffett, a young money manager at the time, decided to do his own research. He didn't just read the headlines, he did the on-the-ground work of a true business analyst. He went to banks and asked if they were still recommending American Express travelers' checks. They were. He went to restaurants and watched diners, observing that they were still paying with their American Express cards. He spoke with merchants. What he discovered was that the scandal, while devastating to the warehousing division, had absolutely no impact on the core business. The power of American Express was not in its warehouses, it was in the trust of its brand and the power of its payment network. People still trusted the Amex name on their cards and travelers' checks. The scandal was a flesh wound, not a mortal blow. The market, in its panic, had confused one failing part of the business with the entire enterprise. Buffett realized the intangible moat was fully intact. He invested over 40% of his partnership's capital into the beaten-down stock and made a fortune as the market eventually came to its senses. This was a real-world stress test of a business moat, and it proved that a powerful brand and network were far more resilient than any tangible asset. The psychological principles that give these intangible moats their power are often social proof and network effects. Social proof is the idea that people will conform to the actions of others under the assumption that those actions are reflective of the correct behavior. It's a mental shortcut. We trust Tylenol for a headache not because we've read the clinical trials, but because our parents used it, our doctors recommend it, and it's a trusted household name. That trust, built over generations, is a form of social proof that creates an incredibly powerful moat for the brand. A new competitor can't simply create that level of trust overnight, no matter how much money they spend on advertising. Network effects are even more powerful. A network effect occurs when a product or service becomes more valuable to its users as more people use it. The classic example is the telephone. One telephone is useless. Two are slightly useful. 1 million telephones create a valuable network. The Visa and MasterCard networks are a perfect business example. We as consumers carry Visa cards because nearly every merchant in the world accepts them. And why do merchants accept them? Because billions of consumers carry them. This creates a self-reinforcing, virtuous cycle. For a new competitor to break in, they face an impossible chicken and egg problem. They can't get the consumers without the merchants, and they can't get the merchants without the consumers. This creates a nearly impenetrable moat that has nothing to do with physical assets and everything to do with the structure of the network itself. Facebook, YouTube, and Microsoft Windows are all businesses built on this same powerful principle. As an investor, when you identify a business benefiting from deep-seated psychological forces like social proof and network effects, you have likely found a moat of incredible width and durability, a true fortress for building long-term wealth. To operationalize this search, you need a framework for identifying these different types of moats. Let's call it the 5-moat identification framework, focusing primarily on the intangible sources of durable competitive advantage. The first and most famous is brand. A truly great brand allows a company to charge a premium price for a product that is often functionally identical to its competitors. Think of Nike shoes versus a generic sneaker, or a Tiffany & Company diamond versus an unbranded one. The key question for your stock analysis is, does the name itself create pricing power or a deep sense of trust? The second moat is network effects, which we just discussed. Does the value of the service increase for every new user that joins? This is the moat of companies like Visa, Facebook, and eBay. The third moat is high switching costs. This exists when it is expensive, time-consuming, or just a massive pain for a customer to switch to a competitor. Think about the bank where you have your checking account. Switching to a new bank would mean changing all your direct deposits and automatic bill payments. It's a hassle, so you stay put, even if another bank offers a slightly better deal. Enterprise software companies like Oracle or Microsoft are masters of this. Once a company builds its entire workflow around their software, the cost and risk of switching to a new system are astronomical. The fourth moat is patents and intellectual property. This is most common in the pharmaceutical and technology industries. A patent grants a company a legal monopoly to produce a specific drug or technology for a set period. This is a very strong but often temporary moat. The fifth moat is a cost advantage, which can sometimes stem from an intangible asset like a unique corporate culture or a proprietary business process. Think of Costco's incredible supply chain efficiency, or Geico's direct-to-consumer model, which Buffett has owned for years. These process-based advantages are difficult for competitors to replicate. As a retail investor undertaking your financial education, learning to look at a business through this 5-moat framework is a game changer. It forces you to think not just about what a company does, but why it will be able to continue doing it profitably for a very long time. The antithesis to this disciplined search for moats is the common but perilous path of chasing disruptors and fads. The average investor is constantly bombarded with stories of the next big thing, a revolutionary technology that is going to change the world. They are drawn to excitement and novelty. While some of these companies do succeed, the vast majority do not. The reason is that a technological edge is often not a durable moat. A new invention can be quickly copied or improved upon by a competitor. Think back to the dot-com bubble of the late 1990s. There were dozens of companies that were hailed as disruptors: Pets.com, Webvan, eToys. They had new technology and exciting stories, but they had no real moat. They had no brand loyalty, no network effects, and no switching costs. They were simply the first to market in a new space, and as soon as larger, better capitalized competitors entered, they were crushed. The investor who chases fads is mistaking a temporary advantage for a permanent one. They are buying a lottery ticket, hoping they have found the 1-in-1,000 company that not only succeeds, but also builds a durable moat around its success. The intelligent investor, on the other hand, prefers to bet on certainty. They would rather own the established toll bridge business with a wide moat that will be earning predictable profits 20 years from now than the hot new disruptor that may not even exist in 2 years. This is a crucial distinction in investment strategy. The path of the 99% is a speculative chase after what is new and exciting. The path to building real wealth is a patient partnership with businesses that are durable and protected. The direct financial evidence of a strong moat can be clearly seen on a company's income statement, specifically in its profit margins. A company with a durable competitive advantage has power over its suppliers and its customers. It doesn't have to engage in destructive price wars with its competitors. This allows it to maintain high and stable gross margins and net margins over long periods. Let's compare a company with a powerful brand moat. like the luxury goods maker LVMH, to a department store that sells other companies' brands. LVMH can command incredibly high prices for its Louis Vuitton bags and Tag Heuer watches, not because the leather or steel is magically better, but because of the power of its brand. This results in consistently high gross margins. The department store, on the other hand, is selling products that are available elsewhere. It has to compete on price, constantly running sales and promotions, which crushes its margins. As an investor performing stock market analysis, looking at the long-term history of a company's profit margins is one of the best quantitative indicators of a moat. If the margins are consistently high and stable, or even expanding, it's a strong sign that the company has a protective barrier around its business. If the margins are low and volatile, it suggests the company is in a fiercely competitive commodity business. These stable, high margins are what allow a business to generate the predictable and growing free cash flow that we know is the ultimate source of shareholder returns and the engine of long-term portfolio growth. This brings us to our fifth and final pillar, the culmination of our entire strategy, adopting the owner's mindset with a specific focus on capital allocation in a capital-light world. It's not enough to just find a capital-light business with a wide moat that gushes free cash flow. The final piece of the puzzle is what the company's management does with that cash. A brilliant business run by a foolish manager can still be a mediocre investment, and there is no better case study in brilliant capital allocation than Warren Buffett's management of Berkshire Hathaway's own cash pile. As his early investments, See's Candies, the Buffalo News, the insurance operations, began to mature, they started generating enormous amounts of cash. This cash was far more than they needed to maintain or grow their own operations. A typical CEO might have been tempted to reinvest that money back into the candy or newspaper business, perhaps by launching a massive, ill-advised expansion. This is where Buffett's genius as a capital allocator shone through. He understood that his primary job was not to be the world's best candy salesman or newspaper publisher. His job was to take the excess cash generated by those wonderful businesses and redeploy it into the most attractive investment opportunities available, wherever they might be found. He took the cash from See's Candies and bought stock in Coca-Cola. He took the float from his insurance companies and bought the Burlington Northern Santa Fe Railroad. He acted not as a manager of any single business, but as a rational, dispassionate investor for the entire enterprise. This is the ultimate advantage of the capital-light model. The cash flow it produces is liberated. It is not tethered to the capital needs of the business that created it. This gives a skilled capital allocator like Buffett an incredible range of options to create value for shareholders. This CEO mindset, this focus on rationally allocating capital to the highest return opportunities, is the final, crucial ingredient for building a compounding machine and achieving financial freedom. The reason most CEOs fail at this crucial task is rooted in two powerful psychological biases, the endowment effect and the empire-building bias. The endowment effect is our tendency to overvalue something simply because we own it. A CEO who has spent their entire career in one industry, who has risen through the ranks of a single company, naturally develops a deep affection for that business. They fall in love with it. When the business generates excess cash, their first and often only instinct is to reinvest it back into the business they know and love, even if the prospective returns on that investment are mediocre. They would never dream of investing that money in another company in a different industry, even if the returns were projected to be much higher. That would feel like a betrayal. Compounding this is the empire-building bias. There is a deep-seated human desire to preside over a larger, more sprawling enterprise. CEOs are often compensated and judged based on the size of the company they run, not on its per-share profitability. This creates a powerful incentive to grow the empire at all costs. This leads them to pursue large, flashy acquisitions, often overpaying and venturing into businesses they don't understand, simply to make the company bigger. Buffett's superpower is his almost complete immunity to these biases. He is famously rational and detached. He views the cash Berkshire generates as belonging to the shareholders, and he sees his job as finding the best possible home for it. whether that's inside Berkshire or outside of it. He is focused on increasing per-share intrinsic value, not on building an empire for its own sake. The intelligent investor must learn to evaluate management teams on this same criterion. Is the CEO an empire builder, or are they a rational capital allocator focused on per-share returns? The answer to that question will have a massive impact on your long-term investment success. To make this evaluation practical, you can use an applied mental model we'll call the shareholder yield scorecard. This is a simple tool for grading a management team's skill as a capital allocator, which is a critical part of any thorough stock analysis for long-term investing. There are 3 key components. Step 1. Calculate the dividend yield. This is straightforward: the annual dividend per share divided by the stock price. It tells you how much cash the company is returning to you directly. Step 2. Calculate the buyback yield. Look at the company's financial statements to see how much money they spent on share repurchases over the last year. Divide that number by the company's current market capitalization. This tells you how much the company is returning to you by shrinking the share count and increasing your ownership stake. Step 3. Add the dividend yield and the buyback yield together. This combined figure is the shareholder yield. It represents the total amount of value being returned to you, the owner, as a percentage of your investment. A company with a consistently high shareholder yield is a good sign that management is focused on its owners. But there's a final, more qualitative step. Step 4. Evaluate the wisdom of their acquisitions and other investments. Are they using the remaining cash to make smart, bolt-on acquisitions in their area of expertise? Or are they engaging in what Peter Lynch called diversification, buying unrelated businesses and often overpaying for them? Reading the chairman's letter in the annual report can give you great insight into the CEO's thought process. By using this scorecard, you can move beyond just analyzing the business and begin analyzing the skill of the people running it. This is a crucial layer of analysis for anyone pursuing the path of the intelligent investor. The antithesis of this disciplined capital allocation is the all-too-common diversification trap. This happens when a company with a wonderful, cash-gushing core business finds itself with more money than it knows what to do with. The management team, driven by the empire-building bias and a feeling that they must do something with the cash, decides to diversify into a new industry. The problem is, they usually know nothing about this new industry. A classic example from business history is the wave of acquisitions made by tobacco companies in the 1980s. Facing litigation and a declining market, companies like R.J. Reynolds had a core tobacco business that was still generating enormous amounts of free cash flow. Instead of returning that cash to shareholders, they decided to diversify. Reynolds bought Nabisco, a food and snack company, in a massive, high-profile deal. The strategic logic was fuzzy at best, and the company struggled for years to manage these two wildly different businesses. They had taken a focused, albeit controversial, cash-generating machine and diluted it with a completely unrelated enterprise in which they had no special expertise. This is diversification. It often happens because a CEO from a mature, capital-light business gets bored. They want the thrill of growth and deal-making. But this desire for action often leads to the destruction of shareholder value. The 99% of investors often applaud these moves, seeing diversification as a prudent way to reduce risk. But the intelligent investor knows that it is far better for a company to stick to its knitting, dominate its area of expertise, and return the excess cash to shareholders, who can then choose how to diversify their own portfolios. Recognizing the warning signs of diversification, a management team talking about synergies between unrelated businesses, a history of overpaying for acquisitions outside their core competency, is a key skill for protecting your capital. The ultimate financial connection of brilliant capital allocation, especially in a capital-light business, is its impact on the per-share metrics that drive your returns. As we touched on earlier, the simple act of a share buyback is one of the most powerful and misunderstood forces in wealth creation. Let's make it crystal clear. Imagine a business that earns $100 million in free cash flow every year, and its profits never grow. A boring business. It has 100 million shares outstanding, so its free cash flow per share is $1. The stock trades for $10, a price-to-free cash flow ratio of 10. You own 100 shares, an investment of $1,000. In year one, the company uses its $100 million in cash flow to buy back 10 million of its own shares at $10 each. Now, there are only 90 million shares left. In year two, the business is still flat, earning another $100 million. But now, the free cash flow per share is $100 million, divided by 90 million shares, which is $1.11. That's an 11% increase in per-share value, even though the business didn't grow at all. If the stock market continues to value the business at 10 times free cash flow, the stock price will rise to $11.11. Your initial $1,000 investment is now worth $1.11. The company repeats this process year after year. It keeps earning its $100 million, and it keeps using it to reduce the share count. Over a decade, the number of shares outstanding plummets. Your ownership stake in the business grows larger and larger each year, and the per-share value of the business marches steadily upward, all without the business itself needing to achieve any heroic growth. This is the hidden rocket fuel of great capital allocation in a capital-light world. It is the engine that drives portfolio growth and is the mathematical foundation for achieving true financial independence. It is the final promise fulfilled, a business that works tirelessly for you, its owner, turning its own success into your ever-increasing wealth. You have now journeyed through the 5 pillars that form the foundation of one of the most powerful investment philosophies ever devised. You have moved beyond the superficial and the tangible, learning to see the invisible architecture of value that supports the world's greatest businesses. You now possess the lens of the intelligent investor, the ability to distinguish a true cash flow fountain from a capital-intensive treadmill. You understand that a brand can be more valuable than a factory, that free cash flow is the ultimate measure of success, that a durable moat is the only true source of security, and that the skill of a capital allocator is the final multiplier on your returns. This knowledge is not just theory. It is a practical toolkit that forever changes how you will look at the stock market and the world of business. But mastering this framework, as powerful as it is only the first half of the equation. Identifying a wonderful, capital-light business is a critical skill, but it is not enough. A great business bought at a terrible price can still be a terrible investment. The next critical question, the one that separates the amateur from the professional, the one that Buffett himself obsesses over, is how to value these incredible, intangible assets. How do you put a number on the power of the Coca-Cola brand? How do you calculate the intrinsic value of Visa's network? Answering this question is the bridge from identifying quality to profiting from it. It is the final link in the chain of logic required for building lasting wealth. The video that is now appearing on your screen is that missing link. It is the next piece of the map. It takes the qualitative understanding you have just built and fuses it with the quantitative discipline necessary for intelligent execution. It is the bridge that connects the ton, what, to the how much. It is the key to turning your newfound knowledge into a concrete investment strategy that you can use to build your portfolio for decades to come. This is not about simply watching another video. This is about completing your mental arsenal. The choice to click is a choice to graduate from an admirer of great businesses to a disciplined owner of them, armed with the ability to buy them at prices that all but guarantee your future financial success. The most important lessons are the ones that connect, complete the map. The journey continues.